I'll tell you what bothered me about the FOMC meeting in December was the fact that they just didn't seem to see anything. They don't see any softening in the data. Their statements on the economy were exactly the same as we saw in September. They don't see any hint that running off the balance sheet is causing any problems in the economy. And they don't see any risks from financial markets. They're not taking any signal from this 20% down market that we have. So to me, all of that sounds a little bit tone deaf and raises the concern. What would it take for them to pause? What are they looking for before they react?
Do you think that's
to
what the
data?
market's doing here? Trying to dare them, trying to test how far the market can fight the Fed?
Oh, I don't think the market ever really fights the Fed. I think what we're seeing, though, is markets reacting to some of the strains from tariffs. We see big effects from tariffs rolling through. I think we're seeing people reacting to a Fed that doesn't look like they're going to react to the data. You put those together, and you get a downdraft. You know, the good news is if we're right here and it's just tariffs, then it's just a short-lived temporary shock to the economy. We should see better numbers later next year.
Why would it be short-lived if, in fact, there's no deal and we go to 25%?
We actually assume the 25% in our tariff.
That's a big
in
bet.
Our forecast, so that's a big thing. Of course, it's very uncertain around that. But what we think we're seeing right now is manufacturers in the United States shutting down and shortening hours in response to the tariffs. The supply chains are getting hit. As those strains go away, even with the tariffs staying there, then growth picks back up. The underlying economy is still strong.
Nick, we spent a lot of 2017, a lot of us did anyway, trying to explain how the markets just didn't seem to care about what was going on in Washington. The Fed was in tightening mode. You also had a lot of chaos in the White House. So now all of a sudden it matters when the market's in a weakened state. Where do you put the cause and effect in all this?
Yeah, it feels very much like you can layer on a certain amount of uncertainty onto this market, any market, and still see it rise as long as earnings are progressing nicely, which was 2017 and much of 2018. But we hit a breaking point with all these issues all at once in the tail end of a year when tech rolled over in October and we need to make a lot of tax loss sales in December to pull the rest of the market in. And that's exactly what's happening right now. The trouble is there's no horizon to see any one of these individual topics resolve themselves in the next 20, 30, 40, 50 days. And so we're probably looking at maybe a tax loss rally, a January effect in January, but not a whole lot of follow through after that until one or two of these things gets really resolved.
But I think, some would wonder, what is the market already pricing in? Bob Pisani said, is it pricing in a recession at this point? And is that fair?
Yeah.
Given what the data is telling us?
The short answer is no.
No matter what gets resolved.
We're looking at 14.5 times a reduced maybe $160, $162 a share on the S&P, which is flat to this year, i.e. not a recession. And I think it'd be tough to argue to pay much more than 15 times for the kind of uncertainty we're seeing at the macro level right now. So it doesn't feel like we've quite priced in an actual two-quarter GDP or even earnings recession where earnings drop.
Although how depressed would asset prices have to be and for how long for it to self-fulfill, right? For 160 to be at risk.
We're flirting with that right now, absolutely. Because if you talk to individuals, as Rob mentioned, you're beginning to see people pull back on spending. Budgets get settled on right now. Are companies going to be really aggressive in the first quarter with hiring or expansion or investment, given the volatility in the market? It doesn't feel like it.
We haven't seen a requisite pop in claims, right? I mean, at least not yet. Is our calendar issues weird right now?
Calendar's super weird right now for claims, so it's very hard. And remember, claims pick up dramatically in January with everybody coming off of holiday hiring, so January is going to be very important to watch.
Rob, we've had growth scares before, right? We've kind of seized up in advance of a potential downturn in the U.S. economy. It hasn't happened. Where do you actually see the underlying economy going in 2019? Are we just going to be in vigil for a recession in 2020?
So I'm going to split the 2019 into two halves. In the first half of the year, you have the risks from tariffs. You have the extra risk. Cheap oil is a big risk right here, right now. So that first half drag. But then if you can get through that, if you get through that without a recession, you get into the second half of the year, and the underlying bones of the economy show themselves, and growth picks back up.
So how did we get, Nick, to a place where everything is being interpreted as bad news, even if it's maybe not necessarily on the surface bad news? I mean, I'm thinking, look, there was a lot of hand-wringing over the Treasury Secretary's press release that he spoke to 6 bank CEOs about liquidity, and maybe it was a botched kind of communications thing, and they should have just said this was a routine call about the economy and some of the action in the markets, but it shouldn't have changed anything materially for the markets. They're not worried about liquidity. They weren't going into the call, and now they said that they weren't. So I guess how did we get to a point like this? And what do investors do when every little thing like that is getting blamed and spiraled into this negative narrative?
Yeah, there's two related things. The first is I think there's a question of how deep the bench is in the president's administration. And when you see Mnuchin come out with what I would agree was at best a kind of goodwill gesture, but not really very well thought out press release, that creates some cause and some pause. The second is we've seen this market consistently discount headlines 2 and 3 and 4 days ahead. Like, for example, with the Huawei CFO arrest. The market tanked on Tuesday, the arrest was announced on Wednesday. So there's a real caution, and we hear this from clients all the time, about how much does the market know, how much versus I know. And it feels like people are getting a better look, a better call, and that's why markets roll over so fast.
Well, last question. If we can assume Powell is safe from any outside pressure, if Mnuchin is let go, what does the market do?
I think that the administration has a lot of turnover at the moment. As we've been talking about, there's a lot of risk and uncertainty out there. I think losing a Treasury Secretary adds to that rather than alleviating it.